Sairam, dear students, welcome to this session. This is the last session under National Income Accounting. Let us discuss today what is nominal GDP and the real GDP. What are the differences between calculating nominal GDP and the real GDP, and also the relations GDP and welfare. Why GDP cannot be used as an index to measure the welfare of a country. That also we will discuss. These are the topics today we are going to discuss. Yeah, the first objective is to understand the concept of nominal GDP. The second one, to understand the concept of real GDP. The third one, to calculate the GDP deflator. It's a ratio that we will, how to calculate GDP deflator, and also its importance, what the message is conveyed, or what is the importance of having calculation of GDP deflator. And also the last is the limitations of using a GDP as an index to measure the welfare of a country. What are the limitations using GDP? These are the topics we are going to discuss. And nominal GDP, what do you mean by nominal GDP? When we say nominal GDP, is nothing but we calculate the GDP, or that is the evaluation of goods and services for the particular year using current prices. The current prevailing prices is called as this nominal GDP. Therefore, nominal GDP is nothing but value of GDP at the current prevailing prices. And then nominal GDP can increase even without any increase in the volume of physical output. You know, when GDP mean, for instance, we are going to have an example here, that you know, you have 10 sari produced, and each sari is 1,000 rupees, 1,000. Then how do you will calculate value this product, this sari? 10 into 1,000. How much? It is 10,000 GDP. GDP is 10,000. So just an example. You know the unit of product and the price. Then you can calculate 10 sari, each sari per each sari is 1,000 rupees. Therefore, GDP, the product into the price of the product will give you 10,000. Here, when we say the nominal GDP, this is the current prevailing price in the market of sari, that particular brand sari. This is the current prevailing price. When we use current prevailing price to calculate GDP, then we will say that GDP is nominal GDP. Therefore, you can note here the GDP depend on two factors. One, the volume of production. How many volume of production? 10 saris. And also it depends on the price of the commodity. Therefore, when we say GDP increase, price may increase, or number of units of products, number of commodity. That means here 10 sari. This can increase. When the 10 change into 1,000 to 100 sari, automatically the GDP will increase. Or either the volume of product can change or the price increase. For example, we say 1,000 rupees. If the price per sari 2,000 rupees per each sari, then also GDP will increase. Therefore, the nominal GDP depend on two factors. One is price, the other one is number of product or volume of the production. Therefore, the nominal GDP can increase even without any increase in the volume of physical output. For instance, I told you 10 saris, and at the rate of 1,000 rupees per each sari, each sari. Now, what is the GDP? 10,000. GDP is 10,000. GDP. But if it's same 10 sari, volume of production didn't increase. Without increase in volume of production, that is number of sari same, but the price have gone up. It has gone up 2,000 rupees per each sari. Same variety of sari, now it is 2,000. What is the GDP now? It is 20,000. GDP is 20,000. This is the example for the GDP, nominal GDP can increase even without any increase in the volume of physical output, sorry, by 10 sari at the rate of 1000, it was there. Now again, due to some circumstances, the same 10 sari, the prices has gone up. Therefore, now the GDP value is 20,000. GDP is 20,000. You can see that is what we are volume without any increase in the volume of product. Nominal GDP can increase. Therefore, nominal GDP mean using the current prices. Now current price was before 1 month 10,000. Now the current price after 6 months it is a current price now. For instance, this January price, January 2020 January GDP out of this sari 10,000. Now we will say in December, now to this December 24th, now the price has gone up due to some reasons. That is 2,000. Now GDP has 20,000. That is the meaning that nominal GDP depend on two factors, not only volume of product, the current prices, change in current prices. When price increase, GDP increase. When price decrease, GDP increase. For instance, this 500,000 rupees, it decline. For instance, in other words, it decrease mean it is 500 mean 500 per each sari, then the GDP will be only 5,000. Therefore, increase in prices or decrease in prices both affects in this nominal GDP, where we use only the current prevailing price. I hope you are clear about it. And as nominal GDP is affected by change in prices also, therefore, nominal GDP not only depend on the volume of physical product, but also depend on change in prices, because that is what we say current price of market, it is calculated, it's called nominal GDP. Then why cannot we rely on GDPs evaluated at current market prices? For instance, if price changes, then there may be difficulties in comparing GDP, because GDP is prices into quantity of commodity, quantity of output, any output, automobile industry, cement industry, textile industry, any output you can take. But this, what is nominal GDP? Nominal GDP, what price uses? Current price. And for example, this is GDP 2000. And again we are going to compare, for the comparison 2001, we want to decide whether GDP has increased or decreased. We want to see that. We want to see GDP in 2000, we want to compare GDP in 2000 in India with the GDP in 2001 in terms of nominal GDP. What you will do now? Because what will happen? Because it depends in both the factors, first factor and the second factor. When really GDP have grown mean, it should have grown in the quantity of output, not because of the price changes. If, for instance, here 10 sari in the term of rupees 1000. In 2000, in the year 2000 GDP, what is the GDP? 10,000 rupees in the year 2000, in the year 2000. But in the 2001, what will happen? Same 10 sari only, same 10 sari, product didn't change, but the price has gone up 2000. Now what is the GDP in 2001? 20,000. 20,000 is GDP. Why? Why? Because 2001 current price is rupees 2,000 per sari. 2000 in the year 2000 GDP is 10,000. The reason is in the year 2000 each sari is 1,000 rupees. Can we say GDP 2000 is only 10,000, GDP in 2001 20,000, therefore growth have increased? No, it is because it is not accurate, because volume of production didn't increase, but the prices have gone up. When prices increase for same commodity, when prices increase, we say inflation. Just for instance, we can say 10 years back, we would have bought Sona Masuri rice for 35 rupees. Now, same quality variety of rice per kg, we paid 70 rupees. What we can say? The 10 years back price and the now price. It has gone double the price. 35 rupees now, so double the price. This is called inflation. Price of the same commodity has gone up now. Therefore, our money value have declined. That is what inflation means. Therefore, when we say GDP 2010 sari at the rate of 1000 rupees, 10,000 rupees in the year 2000. And in the year 2001, because nominal GDP means we just prevailing prices we are using. Therefore, in the nominal GDP in 2001, same variety of 10 saris, the price is 2,000 per sari. Therefore, it is 20,000. Can we say the production has increased, GDP have gone, GDP growth is increased? Can't say, because it is just price has changed due to inflation. But number of product didn't change, only 10 sari between 2000 2001. Therefore, we cannot rely on GDP evaluated at current prices. We can say GDP evaluated at current prices, or other name is what? Nominal GDP. Nominal GDP. Nominal GDP means GDP evaluated at current price. Therefore, we can't rely on GDP and depend on GDP, nominal GDP or GDP evaluated at the current prices. We can't say GDP has grown or the growth of economy has happened, because GDP, nominal GDP also can increase, because merely increasing the prices of the commodities due to inflation, that is money value has declined, Indian currency value has declined because the prices have gone up. That is meant by inflation. Even not only that, if for instance 10 sari is there in the 2000 also, year 2000 also 10 saris. Year 2001 also, year 2000, I am going to explain the deflation now. Year 2000 also 10 saris. 10 sari. What happened here? The price is 1000 rupees. Now, year 2001, same variety of 10 sari, now price is 500, declined, because nobody is not able to buy the saris, because people didn't have money in their hand. You can say recession in the economy, like a COVID time, people don't have enough money, therefore price of the sari has come down. Now, year 2000, what is the GDP? You know GDP, what GDP we are measuring? Nominal GDP at current prices. Nominal GDP at current price is how much? 10 sari at the rate of 1000. How much? 10,000 is GDP in the year 2000. What is the year 2001? GDP 2001, how much? 10 same sari, product didn't change, volume of production didn't change. Say 2000 also 10 sari, 2001 also 10 sari. But the price has come down because of deflation, 500 rupees. Therefore, what is the GDP? 5,000. Therefore, GDP 2001 is equal to 5,000. Can you say growth actually declined? Really, product is same number of saris. Product didn't change, volume of production didn't change. What has declined? Actually, price have declined, because people didn't have money to buy the saris. Therefore, there is no demand. Supply is there is no demand. You know what is when there is a excess supply, lack of demand, what will happen? The demand is shortage. Demand is no demand, because people didn't have money in their hand due to some recession or due to some unexpected circumstances. Saris are available, enough amount, supply is more, excess supply. This is situation called excess supply. People are not buying. When supply increase, what will happen? Price decrease. Before the same sari was 1000 rupees, due to excess supply, now because there is no demand, lack of demand, the supply is more than demand. Demand have declined, therefore price have come down to 500 rupees. Therefore, GDP 2000 and GDP 2001, 10,000, now it is 5,000. You can't really say GDP have come down. Because of the decline in price, it has come down. Otherwise, production didn't change. Volume of production is same. Therefore, we can't predict growth just merely having this nominal GDP, because it depends on two factors. When the price changes, it changes. Even though product may increase, but price changes will influence or increase or decrease, but the price changes will influence the actual value of GDP. Therefore, GDP increase due to increase in the volume of production of the country and also increase in prices of the goods and services. Not increase mean, GDP increase mean. GDP decrease mean what you will say? It may be decrease in the volume of production of the country, other way around, and also decrease in prices of the goods and services, then also GDP decrease. And now, to compare the GDP figures and other macroeconomic variables of different countries or of the same country at different point of time. I have explained you at different point of time now. Just now I explained what is a different point of time. I compared GDP year 2000 and year 2001. Also GDP can compare with the different countries. For this purpose, if we are going to use nominal GDP, it will not be an accurate measure. Sometimes production has gone very much. Production last year, it was only 20,000 tons of wheat. This time it might have gone to 40,000 tons of wheat. But the price last year, the price have come down this year, half the price of the last year. Even though production have doubled the wheat production, the 10,000 tons to 20,000 tons, because of the decline price, what will say? It will say GDP didn't change because price doubled and price declined into half, production doubled. Therefore, nominal GDP will not change. Therefore, GDP is not nominal GDP is not a good measure to compare between countries or within the country at different point of time. GDP is not a good measure. We can't rely on that because it won't convey the message of actual production in an accurate way, because if the price changes will influence, it doesn't have any account to keep under control inflation. Inflation mean increase in price, or inflation mean what? Increase in price. Increase in prices of commodity is called inflation. Deflation mean decrease in prices, because no demand for that good. People didn't have money in their hand to purchase those items. Therefore, decrease in prices, deflation. Therefore, nominal GDP do not account for inflation or deflation. That means decrease in price, increase in price, both. This is decrease in price, this is increase in price. Both will influence the GDP. Therefore, we can't depend on nominal GDP to compare countries, between countries, or at point of time, different point of times in the same country. And we cannot rely on GDPs evaluated at current prices. What is the other name? GDP evaluated at current price is nothing but nominal GDP. We can say GDP evaluated at current price, or in other words, we can say nominal GDP. Nominal GDP, we cannot rely on GDPs evaluated at current market prices or in nominal GDP. I hope you are clear about this concept. Now, real GDP. This one, in contrast to that our concept of nominal GDP, here, real GDP, we do not measure at current prices. Here, we take into account the prices are fixed. As constant base year prices we are taking. We are taking a base year price, and that price is called as constant sector price or constant prices to calculate GDP, not the current prevailing changing prices. Therefore, GDP, real GDP in the sense, goods and services are evaluated. That is, evaluated means price into quantity. We have to, that's how we evaluate GDP. Each goods, the quantity or volume of product is multiplied by the price of the price of that particular commodity. Then we will evaluate GDP. That GDP is, here the price component is a constant set of prices or constant prices. That we say a base year price. We use here a base year price. Base year price. This base year price is determined by experts. experts of Reserve Bank of India, experts of Ministry of Finance, all the experts, economic experts, they observe the changes in prices over the years and they take a basket of commodities and set the base year, and that based on the base year, the successive another year's GDP is calculated. That is called real GDP. For instance, now in India, 2011-12 prices is taken as base year price to calculate real GDP in India. In India, now at current point, they are taking 2011 and 12 prices as base year price in India to calculate the real GDP. Here, since these prices remain fixed, if the real GDP changes, what is changing? Only the volume of production changes, because we keep prices fixed, because we take some constant prices, not changing current prevailing prices. And then if there is any change in GDP, we can be very sure about it. It is nothing due to the changes in prices, only absolutely due to change in the production. The volume of product undergone some changes. That is what GDP has changed. The real GDP increase or real GDP decrease. If the real GDP increased, we can say the volume of production has increased. If real GDP decrease, real GDP. Again, the price and the quantity of product, quantity produced. Then this we are keeping as constant. Therefore, if any change is there in the GDP, this is due to quantity produced. If quantity produced decrease, then real GDP decrease. If quantity produced increase, then real GDP also increase. I hope you understood. Real GDP increase, quantity decrease. If quantity increase, then it should come like this arrow, because of this it will happen. If quantity increase, real GDP increase. If quantity decrease, real GDP also decrease. I hope you understood. Thereby, real GDP is nothing but price into quantity of output. Here we use for the particular year. I will explain with the example in the next page, in the next slide. Real GDP is what? When GDP of a given year, each year we calculate given year, estimated on the basis of constant price of a base year. We use a base year price. It is called real GDP. I will explain you with the example. Real GDP is a better measure to make periodic comparison. For example, we can compare the GDP of 2000 and GDP of 2001. GDP of 2010 and GDP of 2011. For the comparison in between years, how much produced in the country, how much economic growth has taken place, we can use real GDP than the nominal GDP. It is a better measure because it doesn't consider the change in prices. It actually considers the change in volume of product. Therefore, the physical output mean what? Because it keeps the prices fixed. Therefore, any GDP increase or any GDP decline will clearly express whether physical output has gone high or physical output has declined. Therefore, this is a better measure. I hope you understood, of goods and services over different years for the comparison of GDP between different years. That's what Central Statistics Office in India, CSO, calculate the GDP growth between different years. Now, we'll see, suppose a country now we are going to explain the exact example for real GDP and the nominal GDP. We will assume that the country produces only bread, because just a simple commodity we are going to do a simplified GDP calculation. And in the year 2000, they had produced how many units of bread? 100 units of bread, and the price was what? Rupees 10 per bread. Rupees 10 per bread. Therefore, what is the GDP? Price into quantity. Whatever the quantity, 10,000 cars, anything you can produce. Each unit price also you know. the total volume of the product you know, then GDP is what? GDP. In 2001 also they are explaining. Here you can see GDP 2000. How do you calculate GDP 2000? Price into quantity. What is the price? 10 rupees per bread into quantity of bread 100. Sorry, 100. Therefore, how much? It is 1000. It is 1000 GDP. In 2001, the same country, now you can see the volume of product increased by 10 units. 110 units of bread, and even the prices also had gone up. How much a price? 15 rupees per bread. It was before 10 rupees per bread. Now we will see how to calculate GDP in the next slide. GDP at current price, that is nominal GDP, we have seen, no? We have studied already. What is nominal GDP? We calculated in the current price. In the year 2000 is how much? Rupees 10 into 100, rupees 1000. I hope understood. And nominal GDP in 2001, how much? Nominal GDP means current price of the 2001. Current price of the 2001 is how much? 15. And the production units of bread is how much? 110 units of bread. Therefore, what is the GDP in 2001? Nominal GDP. What GDP? Nominal GDP. How much? Rupees 1650. Now, real GDP in 2001 calculated at the price of the year 2000. Now, we are calculated for the year 2001 nominal GDP. What we are going to calculate now is real GDP. For calculating real GDP, what we are going to consider is, we are going to consider the year 2000 price as a base year price. Therefore, we are going to calculate real GDP in 2001, keeping the year 2000 price as a base year price, and considering that price didn't change, only volume changes from 100 to 110. Therefore, 2000 will be called the year 2000, this is year 2000, will be called as base year, because this price is used to calculate the real GDP. Therefore, thus real GDP is how much? 110 units of bread into base year price. This is the price called base year price. Rupees 10, because it is a 2000 year price is used as a base year price, because to see what is the exact growth of GDP keeping the price constant. That means 2000 also 10 rupees per bread. 2001 also we consider price didn't change. Price kept as fixed. 2000 also price kept 10 rupees. Now 2001 also, even though price has increased, that is we are using for increased current price for nominal GDP in 2001. But in 2000, we don't want to use increased price. We say, only we assume the bread number in the 2000 was 100 bread. 2001 it is increased 110 units of bread. And only we allow the change in volume of product, but we keep the price fixed. Therefore, in 2001, when we calculate real GDP, we take the price of 2000 as a base year. Therefore, what is that? 110 into 10. Rupees 1100. That is the real GDP. Therefore, you can see the difference. Nominal GDP in the same 2001 is 1650. The real GDP for the same year 2001 is 1100. What is the assumption here? Only volume of production changed, price didn't change. Therefore, this is because price kept under control, GDP, real GDP is less. Here price also, the current price was used, GDP was more. I hope you understood. And GDP, therefore real GDP you know 1100 for the same year 2001, and for the same year 2001 nominal GDP is 1650. Therefore, here GDP deflator. What is GDP deflator? GDP deflator is nothing but nominal ratio between nominal GDP we write by the capital letters, over real GDP we write in a small letter. Therefore, ratio between nominal GDP to real GDP is called as GDP deflator. GDP deflator. Therefore, GDP deflator always they ask for the exam point of view. In the exam point of view, they will ask what do you mean by explain GDP deflator. You have to explain GDP deflator is the ratio between nominal GDP and real GDP. And nominal GDP is noted by capital GDP. This sign stands. That's what GDP stands for, nominal GDP. And the real GDP it stands small GDP, it indicates the real GDP. Therefore, nominal over real, that ratio is nothing but GDP. You understand, don't memorize anything. Understand the concepts very clearly. And therefore, here this capital GDP stands for nominal GDP. This small GDP, what we indicate by this small GDP is a real GDP. I hope you understood. This has always been asked for the exam point of view also. And the ratio of nominal GDP to real GDP is called as GDP deflator. It is what it gives us. Gives us an idea of how the prices have moved from the base year to current year. Therefore, GDP deflator is nothing but is a price index. Why? When we calculate GDP deflator mean, this is the nominal GDP, this is the real GDP. Nominal GDP we use current prices, real GDP we use the base year prices. Therefore, when we calculate nominal GDP, we current price, real GDP we doesn't change the price. We keep the base year price, only we change the volume of product. Therefore, what it gives us this ratio gives us how the prices increased or decreased, price has changed. In our example, between 2000 and 2001, how much price have moved up or down? That is what indicated by GDP deflator. We will see by an example, numerical example. Base year, what is the base year? The year whose prices are being used to calculate the real GDP is called base year. Also they used to ask, what do you mean by base year? Define the base year. What is base year? The year whose prices are used for the calculation of real GDP, that is called as base year. Base year is the year, that year prices or whose prices being used to calculate the real GDP there. That means you have to say that base year prices are being used to calculate real GDP, where we consider the prices didn't change, only between the years, only volume of product changes. That is called base year. And GDP deflator. GDP deflator we can also denote it in a percentage terms, or GDP deflator we can just a ratio also. Yes, you mean 1650 divided by 1650 is the GDP, nominal GDP. This one is what? Real GDP. Therefore, nominal GDP is 1650. Real GDP we have calculated in our previous example, 1000. That means what is this? 110 rupees, 10 units of bread into 15 rupees. It will give us 1650. And this one, what is that? We didn't change the price. We took the base year price and the output of 2001. It will give us 1000. How much it is? 1.5. 1.5. We can just mention GDP deflator as a ratio between nominal GDP to real GDP, or we can also mention as a percentage changes. Nominal GDP is always referred by capital letters and real GDP small letters into 100%. This way also you can say GDP deflator. Therefore, GDP deflator also can be expressed in the form of percentage. Then what do you do? 1.5 into 100. How much? 150 percentage. 150 percentage. This is the way calculated GDP deflator. Like that GDP deflator, you can also calculate GNP deflator. Here only we are considering in our syllabus GDP deflator. You can also calculate GNP deflator. Again same, GNP, capital GNP at current price and small letters GNP at the base year price. Hope you understood. And here, if you value GDP deflator in the percentage term, then you will get 150%. What do you mean by that? Thus, why it is like that? How do you will interpret this this value? For example, 1.5 per unit price rupees 10, where year 2000, year 2001, bread per unit price rupees 15. What you can say? That means you can say between the year 2000 to 2001, price have increased 10 to 15. How much? 1.5 times. How much? Initial price 10, 1.5 times how much? 15. It is true, no? It is true. 2001 price is 15. Why? It has increased, the base year price have increased by 1.5 times. 1.5 times into initial price. How much initial price? 10. 1.5 times into multiplication by 10 is how much? Rupees 15. Therefore, we can prove that really year 2000 price, bread price per unit is rupees 15. Or you can say 150%. What is that 150%? 150% we can write 150 divided by 100 into initial price 10. This 0 cancel, this 0 cancel, how much? 15% increase. Okay, we can say 1.5 times of the 2000 year price increased, or that is the 2001. 2001 price is nothing but 2000 year price 1.5 times the price of 2000. Price of 2000. What is price of 2010? Or you can say how much? 15% increase. That's 150% increase. Sorry, that is 15 by 15. That is what we have to explain this answer of the GDP deflator. Therefore, the price of bread produced in 2001 was 1.5 times the price in 2000. 1.5 times in price in 2000 means 10. 1.5 times into 10 is 15 rupees. And which is true because the price of bread has indeed gone up from rupees 10 to rupees 15 between the year 2000 and 2001. Therefore, you know, you are very clear now. The GDP deflator gives an idea how the prices have gone up or gone down between the years. That's because it's a price index. It doesn't just gives us the change in prices, and it will be keep here volume fixed. In the calculation of real and nominal GDP of the current year, the volume of production is fixed. We have calculated 2001, 2000 also, we used year 2000 also, we used 110 units of bread. 110 units of bread, price was 10. Then even year 2000 also, 2001 also, when we calculate GDP 2000, GDP 2001, this is nominal GDP, this is real GDP. Here also same, 100 units of bread, but price only changed. Therefore, here, this is 15, that is a nominal price, this is base year price. Therefore, only here 15 rupees, here we are using the base year price. Therefore, only the prices changes 15 to 10, but volume of product didn't change. That is what they are telling. In the calculation of real GDP and therefore, real GDP and nominal GDP mean, for the same year we are calculating, for 2001 only, nominal GDP 110 into 15, that is 1650 rupees. 2001 again same year only. What we are calculating for the same year, that very much important. You have to same real GDP we have calculated. Real GDP, what is that? Real GDP 110 only, same volume, but the price we don't take 15, We take base year price 2000 year price. How much it is? 1100. 1100. Therefore, 2100, same year we are calculating nominal GDP. For the same year we are calculating the real GDP. We are keeping same year units of product, both are fixed, but only the price changes. For nominal GDP we use the current year 2001 price. For the real GDP we use, even though product is 2001 product, but we use the base year price, taking year 2000 price as the base year price. That is the difference. Therefore, volume of production is fixed. Here, the calculation of real GDP in the 2001, both nominal and real. And therefore, this deflator, GDP deflator is called as price index. Why? Here only prices changes. Thereby we come to know between 2000 and 2001 how much price has gone up, because we keep product fixed. 110 bread also 2001 nominal GDP, 110 bread in the 2001 real GDP also. Therefore, the ratio of nominal real GDP is a well-known index of prices. You have studied in your first year consumer price index, CPI. Same way, this also price index only. It is express or it represent the changes in prices between years. And this is called GDP deflator or price index. Why we say price index? Now you would have understood. Because it just takes the changes in price. It compare the current price with the base year price. And it says it's gone up or come down. And now we finished the sections. The last topic we have studied nominal GDP, real GDP, GDP deflator and its message, its importance. And now we are going to see GDP and welfare. We are going to see GDP is but you know what is GDP? Is the sum total or the aggregate value of all the final goods and services produced in a domestic economy or the geographical boundary of a country within the country. That means domestic economy means within the country, or we can write in other word geographical boundary of a country in a particular year. All these terms is very important. Within the domestic economy, or you can say geographical boundary of a country, not outside the country, and this aggregate, or you can say sum total, and you have to mention very much final. You have to say sum or aggregate. Instead of you can write aggregate also. These terms should be there when you define GDP. And therefore, what is the limitation of using GDP as an index of welfare of a country? We can't rely on GDP to assess the welfare or development of a country, because GDP is not alone is a good measure to represent the welfare of a country. Why? The distribution of GDP, how uniform it is. You know, in most of the countries, in developing countries, most of the GDP mean what? National income is in the hands of only 10 or 20% of the population of the country. The rest of the population remain poor, because this all the accumulated wealth in the hands of the rich people. Therefore, the distribution of GDP is not equal among the people between poor and rich. Therefore, when there is such disparities or the differences in the distribution of GDP, and most of the income is accumulated with the help in the hands of concentrated in the hands of rich people, then that GDP we can indicate that GDP is high. Therefore, welfare of the nation is high, because only the welfare of the rich people is high. Still, all the large amount of population is remaining in poor only. Therefore, GDP can't explain the welfare of the nation accurately. We are going to explain that if the GDP of the country is rising, we can say the welfare also may rise, may not increase as a consequence. The reason is the concentrated GDP, in other words, is what? National income. It is in the hands of all the rich people. Therefore, we can't say welfare of all the people are increased, because poor people remains poor. Their welfare is poor welfare. And because the rise in GDP may be concentrated in the hands of very few individuals or firms, those individuals only will be better off in the welfare. But other people will be worse off, because the poor GDP, poor income in their hands. Therefore, for the rest, the income may in fact have fallen. Therefore, GDP is not a good measure to indicate the welfare of the country. We are going to see with the help of an example. Here example, this is an imaginary country, we will say for the easy calculation or the simplified economy, a simplified example. An imaginary country had 100 individuals in the year 2000. We say very small country, only 100 people for simplification of the calculation. Imaginary, okay, that's what we are saying, imaginary. Each individual earning rupees 10. GDP in the year 2000 is equal to 100 individuals. How to calculate GDP? Each individual earning 10 rupees. What is the total number of individuals? 100. Therefore, GDP is what? 100 individual times rupees 10. It will give you rupees 1000. This is the GDP in this imaginary country of 1000 individuals. And we'll take another example. Same country only. This is for 2000 year. Here we are comparing the same country and same population between 2 years, 2000 and 2001. What is happening in 2001? Same country with the same content of population, 100 people. What is happened? What happened was 90 individuals only earning 9 rupees each. That means here all the 100 earning rupees 10 in the year 2000. But in the year 2001, what happened? Because of some disparities, what happened? 90 out of that 100, 90 individuals income declined from 10 rupees here to 9 rupees. And on the other hand, the rest 10 people individual income have increased from 10 rupees to 20 rupees. Double the income increase for only for the minor percentage 10 people. But the majority of the 90 people income declined from 10 to 9. Therefore, GDP in 2001, how to calculate? You have to divide. Now 90 people times 9 rupees plus 10 people times 20 rupees. Therefore, 810 plus 200, 1010. What happened to GDP in 2001? It increased by 10 rupees, 1010. Here how much it is? Rupees 1000. Whether we can say here, by having GDP in 2000 and GDP in 2001, whether we can say that GDP have gone up? Yes, really GDP have gone up. Why? In 2000 it is 1000 rupees, 1000 GDP. In 2001 same population rupees 1010. By 10 GDP have increased. But can we say the welfare of the people also have increased? Definitely not. Why? Because even though the GDP have increased by 10, but the majority of the population, 90% of the population, their income has declined to 9%, to 9 rupees. But only 10% of the population have benefited. Only their 10% of the population's welfare has gone up because their income is doubled from 10 rupees to 20 rupees. Therefore, we can't say only very minimum number of people got better off and 90% of the population is worse off. Therefore, there is no welfare. We can't say by having increase in GDP, we can't say there is an increase in welfare. This is the example. Always they asked, they used to ask, explain GDP is not a good indicator to measure the welfare of a country. This example also you have to cite as an example for that answer. It's a 20 sentences long answer. I hope you understood. Now, from the above example, we can say GDP of the country in 2001, our imaginary country, was higher by rupees 10 because 2000 it was rupees 1000, GDP. 2001 it was 1010, it increased by 10 rupees. And 90% of people of the country have seen a drop in the real income 10%. Why 10%? From 10 to 9. 10 to 9. Therefore, what is it? What is the 10%? How do you calculate? 10 to 9 mean what is the difference? Change in income 1 by 10 into 100. How much? 10%. 10%. Therefore, 90% of the population's income have declined by 10% compared to the year 2000. Why? 10 to 9 it declined. Therefore, change in income 1. For original income 10. For the 100%, how much? 10%. I hope you understood. And only 10% have benefited because of the rise in their income by 100%. Why it is 100%? Because 10 to 20 increased. 10 to 20 increase means how much change? 10 change, initial income 10 into 100%. This one will go. Therefore, how much change? 100% change. Double the income, 10 to 20. Therefore, income increased by 100%. Only for how many percentage of the population of out of 100 people? Only 10%. Therefore, because 10% of the people's income have doubled, we can't say the whole welfare of the country as imaginary country have gone up. It is wrong because 90% their income have declined. Therefore, this all you have to explain in your answer. That is the proper way to write the answer for that question. 90% of the people are worse off. Only 10% of the people are better off. Though the GDP of the country has gone up by 10. Why? 2000 it was 1000. 2010 it was 1010. By 10 it has gone up. But if we see the how many have benefited, only 10% have benefited because of the double the income, and 90% because of the decline by 10 rupee to 9 rupee worse off. Therefore, what we can say, only 10% of the people benefited. Therefore, GDP is not a good index or a good indicator to measure the welfare of a country. If a country have to be we have to say that all the people are better off. All the people must have increased income. All the people must have increased facilities, housing, all the sanitation, good drinking water, education, everything should be there, healthcare facility. Then only we can say welfare of the country is better. For example, only 10% people are accessible to the education, good healthcare facilities, good drinking water facilities, and 90% of the people are not well off. They don't get a good education, good healthcare, good standard of living, good healthcare facilities. Then we can say that country is having a good welfare. I hope you understood. Now, second limitation is non-monetary exchanges. That means if the GDP has to be calculated, all the economic activities has to be evaluated in terms of money. But in the household, all the women work, all the women activities at home, home gardening, or women are tailoring for their own family, they are cooking, washing, cleaning. We are not paying for our mothers or sisters who are doing at our household work. They are not evaluated in a monetary value or monetary term. Those unpaid work of the family members of women, it cannot be considered under GDP calculation. This is a drawback. Therefore, we can't say many activities in an economy are not evaluated in monetary terms. Therefore, the domestic services, that means services at home by mothers, sisters, perform at home are not paid for. We are not paid. Any money paid only, it is coming under the calculation of GDP. If there is no money transaction, it will be left out. When there is no transaction, we are not going to include under GDP. Therefore, GDP is not because so many people are contributing for the welfare of others. But it's not all are evaluated in terms of money. For instance, your father or mother teaching you at home, it's not paid for. They are very good teachers. They give so much of knowledge to you, but they are not paid for. And goods or services are directly exchanged against each other without the help of money are called barter exchanges. In underdeveloped countries or in developing countries, mostly very backward country areas, what they do, the people who have milk, they will supply milk for the farmer who has rice. Therefore, milk is exchanged for the rice, or milk is exchanged for some vegetables. Rice is exchanged for some cloth, textile people, they will give the weaver the rice bags and they will get the sari or dhoti. Therefore, the goods to goods, commodity transaction, that is commodity to commodity transaction, without the intervention of money, that is called barter exchanges. It was before the money developed, money concept developed. They were barter exchanges without the usage of money. Therefore, this still is there. When the exchanges takes place commodity to commodity without using money, then it cannot come under GDP calculation. Therefore, those production activities, those transaction activities are left out without included in the GDP. Therefore, GDP cannot measure all the economic activities with non-monetary transaction. Therefore, GDP is not a good measure in terms of this type of barter exchanges. Therefore, since money is not being used, these exchanges are not registered as part of the economic activity. If they are not registered as a monetary activities involved with the money, then they are not being considered under GDP. Therefore, GDP underestimate the values of all these activities. And in developing countries, barter exchange takes place, but they are generally not counted in the GDP. You know why it is not counted? Because GDP only take monetary values. And this is one of the limitations using GDP as a measure of welfare of a country. This is the second limitation, that is called non-monetary exchanges. I hope you understood these non-monetary exchanges. And the third one, externalities. What is externalities? Externalities mean the benefits or harm done by a firm or an individual to another, but they are not paying any penalty for the harm they done, or they are not paying any benefit for the good they have done. In that case, it is not called as externality. I will explain further. And externality, there is no market to buy and sell. Externality cannot be evaluated in monetary terms because nobody is paying also, there is no market also for externality. Therefore, we will take an example, externality. For example, there is an oil refinery industry, a big industry. There are so many industries, oil refinery by different companies. Oil refinery industries is there. What they do? They refine the oil, crude petroleum. They refine the crude petroleum. What is the output they get? They get refined oil. What they do? They sell in the market. After selling the market, what they do? They earn revenue. Therefore, this oil refinery, by refining the crude oil, crude petroleum oil, what they do? They get the refined oil, they sell it and they earn the revenue. That is an economic activity because in the monetary term, they put the money. But in this process of production of refining petroleum, what is happening is they discharge pollution where? In the nearby river. Therefore, this is one side it is taking place. All the big, very massive industries of refining oils, how much pollution will be discharged? You can imagine. Where all are dumped nearby river. What will happen? This pollution will harm the people who drink the water from the river, harm the animals, harm all the other organisms, and it polluted the water body. It polluted particular river or the water body. All the plants, water plants, aquatic animals, all will be damaged. And they kill fishes or other organisms. Then when they kill fish, what will happen? The fisherman who depend on this lagoon or river, his livelihood will be affected. But this section, they only concentrate refining oil selling in the market, but nobody bothers how this pollution affect the environment, affect all the aquatic animals and aquatic plants, and how it affects the people who drink the water, and they don't consider the people who depend on for their livelihood as a fisherman on the river. For this damage, this oil refinery never paying any penalty. Only they estimate the GDP based on how much oil was sold in the market. But this negative damage was never considered or not paid for. There is no market for that. Therefore, this is called negative externality caused by the oil refinery. I hope this chart is explained to you well. What is negative externality? Really, their GDP consider only the amount of refined oil was sold in the market, but never GDP consider these things because there is no monetary value to evaluate the damage. Not even the oil refinery is ready to pay for the penalty or the cost how much they have harmed so many sectors. Therefore, externalities, such harmful effects of the oil refinery that inflicting on others for which it will not bear any cost, it will not take the responsibility of inflicting or causing a negative impact on this environment and the fishermen and the people and the organisms and aquatic animals and all. Therefore, for which it will not bear any cost are called externalities. Understood? It is not even accounted under GDP, there is no monetary value. It is not even paid for the people who are affected, fishermen or all the other people. Therefore, in this case, GDP is not taking into account negative. This is the example for negative externality. This is the example for negative externality. And therefore, in this case, GDP as a measure, welfare of the economy, overestimating the actual welfare. What they do? They just take how much oil refined by that industry, oil refinery industry, how much it is sold, how much earned, that much only. But really they have to deduct some value of the GDP for the damage caused by the pollution of the industry, refinery, oil refinery. But they don't do that. Therefore, what they are doing? They are overestimating, but still the damage is there, negative cost is there. It is not included. Therefore, that negative effect of the environment is not considered by this overestimating. Therefore, without considering the damage, what they are doing, they are actually calculating GDP, it is overestimated. And this was an example of negative externality. There are externality two types. One is positive externality, second one negative externality. But we have studied in under our syllabus negative externality. When there is negative externality, without considering you are calculating GDP, what you are doing? You are overestimating the actual welfare. Really welfare is damaged by this pollution, but it is not considered. Therefore, you are overestimating what? Welfare of the society, but still really damage is there. And then there can be positive. I said two types of externality, positive externality and the negative. Positive externality as well is there. For instance, in your locality, there is a flower garden, a big large acreages of flower garden, roses, all fragrant, very scent fragrance are emanated from that garden, rose gardens and all of the flowers, so much of honeybees are there, so much of, it is so recreation to see you early morning, the surrounding houses, the people around the garden, big estate, that garden, they get pure air, they get a very fragrant smell. The watching itself will give a very good recreation. That means you are getting a very positive thoughts and all, and basic no pollution. In that case, no people surrounded by that garden are ready to pay for whatever the benefits they are getting from that garden. Only that gardener or the owner of that entire horticultural plants, he get by selling the flowers in the market, he gets some revenue. But at the same time, all the people surrounded in that garden, surrounded by the garden, so much of benefit. They are getting fragrant smell, they can enjoy all the fragrance and all the pure air coming from that, all the oxygen, everything coming from that garden they can, but no one is ready to pay for that. There is no valuation for that. There is no market for that. That is called positive externality, come from the garden, a flower garden. And then on the other hand, there is a very extinct, very smelly, so much of dump garbage is there. That municipality or somebody dumped there. Your house is next to you, that dumped garbage. What will you get? Positive or negative? You can't even open your window. So much of mosquitoes, no pure air, polluted air, very stinking smell. It's a negative externality. In that case, it is a negative. Whatever the positive things you are getting from a second party or third party, but you are not paying for them, then you consider it as a positive externality, like a flower garden next to your house. And in such case, GDP, when there is a positive externality, GDP will be underestimate the actual welfare. Flower garden, not the income they are getting directly by selling the flowers in the market, but that flower garden cost another very positive impact on the surrounding environment by having a clean air, a fragrant smell, a recreating facility for all the people who are surrounded by that. So much is there, but nobody is evaluating that. Therefore, what they are doing, when there is a positive externality, they are underestimating. You can say rose flower garden. rose flower garden and neighbors surrounding that garden, neighbors surroundings. So many benefits. These are the positive externality. And now the assignment. What is GDP deflator? All these were very much discussed in this video. Please attempt to do it. And these are our institution is for value education. Start the day with love. Fill the day with love. Spend the day with love. End the day with love. This is the way to go. As a student, you can help a weaker student by helping that student using your valuable time. By helping as own brothers and sisters, you can help them and make them to study well and encourage them without wasting time. And that is the end. Love all, serve all. By Bhagavan Sri Sathya Sai Baba. Sai Ram to you all. Thank you.